At my firm, we help hundreds of people each year file and report crypto on their tax returns. But one of the most common questions that people ask me all the time is, can I just start at the current year? If I've traded crypto in prior years, can I just ignore those old years and start with the current year? The answer to that is no. And there are a variety of reasons why we can't just ignore the prior years. And let's talk through some of those. The number one reason why we can't ignore the prior years is because cost basis and acquisition information carries forward year over year. And so what do I mean by that? Well, if you acquired, traded, received, just obtained crypto in a prior year, if we don't go back and look through those records and determine when it was purchased or exchanged for and how much it was purchased for, then we won't have those records. And now in 2024, 2023, and whatever year we're now focusing on doing the taxes, if a sale occurs, we don't have the cost basis information to act against that sale price in calculating your gain or loss. Everyone wants to pay the least taxes possible on their crypto gains. And an easy way to pay more taxes than necessary is to not have cost basis information for your crypto. Of course, you've paid something when you've initially acquired it, but in the eyes of the IRS, you as the taxpayer have the burden to support what you paid for it. And so we need to go back. We need to have the records from those prior years, from those prior exchanges, or however you obtained it, in order to support that it was actually paid for, that you purchased it. Not only that, but also your date of acquisition. Taxpayers, again, we all want to save on our crypto taxes. And one of the easiest strategies is long-term capital gains, or holding your crypto for more than a year. And when you're selling your crypto now, in the future, or in last year, and you just want to focus on doing last year's crypto or this year's, if you've sold that crypto, I'm sure you want to report long-term gains if you've held it for more than a year. But if we haven't gone back and done the crypto accounting and we can't identify when you actually acquired it, well then the IRS would likely say not only do you not have cost basis, but you also have a short-term gain because we can't prove that you bought it over a year ago, that it is in fact long-term. And so we need to actually go back. We need to do the trades and calculate each of the trades and the holding period because it then flows into that current year. So the big two reasons are those, that it impacts your cost basis and that it also impacts your holding period. But another reason is that the IRS, like it or not, is after crypto. Perhaps their top enforcement priority is crypto reporting. There exists a very large tax gap, which is the difference between what people pay on their taxes and what's actually owed to the IRS. And like it or not, the IRS does not love crypto. It's not something that they're very favorable for. And so in looking at ways to minimize the tax gap, crypto is a great way because very few people statistically have been reporting crypto, yet we know these gains are occurring and many people have crypto. So crypto has been a very hot area of IRS enforcement. In fact, we see and we get calls every day from people that are being audited from the IRS or receiving IRS notices. So how do we avoid that? We have seen statistically, and we've helped well over 1,000 taxpayers over the last 10 years report crypto on their taxes. And then we've helped many of those file amended tax returns to go back sometimes several years and report crypto on their taxes. And what we have seen is that by doing so, they have generally avoided audit, avoided further scrutiny, avoided notices because they have reported thoroughly, and that any of the IRS's checks, any of the data that they have that then they're corresponding to what's reported on your return, we're able to meet those and pass those checks because we've reported as thoroughly as possible based on all the available data. People will often say to me, well, will amending my returns to report crypto raise red flags? And statistically, in fact, amended returns are generally at a higher risk for audit than original returns. But what we've seen is that by reporting the crypto, even if it's on an amended return, generally the IRS are leaving those taxpayers alone. They'd much rather focus on the individuals who are not reporting or reporting thoroughly and audit or focus their attention on them. And so if you're watching this video and you're thinking, well, I don't really want to go back and adjust those years, not only is it impactful on the current year, but it's also going to hopefully avoid an audit or further issues from the IRS because you're reporting, and the IRS is getting a lot of information nowadays from a variety of sources. Even places like FTX or even Binance that many people had thought would never be sharing information. For a variety of reasons, they're now sharing information, and it's not far-fetched to assume that the IRS is going to likely obtain this information in the future and use it for audit purposes. And so to get ahead of that, it makes sense to amend returns, report your crypto as thoroughly as possible. There's one final reason to go through all that, and that's for tax planning. In order to do accurate and proper tax planning, you need to know what you are holding today. And by that, I don't just mean the value of the tokens that you're holding. You can pull up a portfolio app and know the value, but you need to know your cost basis and date of acquisition. Because armed with those tools, you can then determine which crypto or tokens to sell, which ones to hold, perhaps to generate a loss, to use those losses against other gains. Check out our video on tax loss harvesting and the benefits of that. But you can also use it to identify long-term positions, how long it takes to hold a certain crypto in order to get long-term capital gains. Again, a great strategy on that as well. And what we've seen many times is that if a client just focuses on the current year, they don't have an accounting. They're not able to get to a place where they can actually account for and know the cost basis of each lot, of each unit of crypto that they're holding. But armed with that information, you can make decisions to drastically reduce your taxes in the current year through methods such as tax loss harvesting and holding for long-term capital gains. If you've watched this video and you're thinking to yourself, well, shoot, I need to amend my taxes, I've got a bunch of crypto to report from prior years, reach out to a tax professional, reach out to our firm or someone like us, get in front of the issue, report on your taxes. If you have any questions, leave a comment below. Thank you.